probably this was the most extreme case. The most extreme phase that stock markets only go up and any setbacks are temporary and inconsequential, which of course just ain't so. Setbacks are multi-years, incredibly painful, and almost everybody in the FOMO category would not stand the pain and will check out.
After some incredible years for the stock market in the late 2010s, the naive optimism of investors and even regulators seems to be catching up to us. Are you feeling nervous looking at the state of the S&P 500 and other indices? It's uncomfortable to see the market struggling, and one might feel a little afraid for the future. In this video, we're going to run through some comments made by Jeremy Grantham in a CityWire interview. He came on board to talk about the so-called super bubble that is growing beneath our feet. Grantham claims that one of the largest stock market crashes in history is headed our way. Stick around until the end of the video because we're going to talk about how to prepare you and your finances for this possible crash. Jeremy Grantham started one of the very first index funds in the world back in the 1970s. Since then, he has gained prominence within the financial community for his ability to read and predict the market with surprising accuracy. His firm, Grantham, Mayo & Von Ochterloo, oversees more than $65 billion of investments for its clients. Let's hear what Jeremy had to say in this latest interview.
I think there's actually quite an insight to be had to recognize that the super bubbles are a separate species. If you average in every bull market, what you get is a story diluted by a dozen irrelevant data points. It simply dilutes the whole point. The great bubbles are ones that have plenty of crazy behavior that sell way at the top of the range of history, and they have this unique feature at the end that there's a divergence at the end of the blue chips going up and the leading speculative stocks going down. That only happens in 1929, in 1972, in 2000, and last year. The only times in history that you've had a decent move upwards in the blue chip S&P and a substantial move downwards in the speculative stocks that had previously led the charge upwards. It is very strange, unique to the super bubbles, and we have just had it. And that's what gave me so much confidence last year that we had entered the zone completely. They are the most extreme points of investor psychology, where you buy into the idea that markets only go up, and probably this was the most extreme case. The most extreme faith that stock markets only go up and any setbacks are temporary and inconsequential, which of course just ain't so. Setbacks are multi-years, incredibly painful, and almost everybody in the FOMO category would not stand the pain and will check out. I think humans are vulnerable to these waves of excessive optimism. I think in a perfect world, well led, with a sensible Fed and good signals being put out, you might be able to go for the best part of a couple of generations without having a super bubble. But in a world where rates are low, speculation is encouraged, asset prices are rising because the rates are coming down, then you're going to have more than your fair share of these crazy moments where everybody believes the Fed is behind them and they can't lose. And that was classically what last year and the year before represented.
Let's take a look back at how the market got into this state. Then we'll examine super bubbles and the role they are playing. The current state of the market is certainly worrying. When the economy teetered on the edge of disaster during the COVID-19 shutdowns, the Federal Reserve used extreme measures to prop up the financial situation. 80% of all US dollars in existence were printed between January 2020 and October 2021. We use the term printing liberally, but that doesn't mean all of those dollars were physical money. This money was then used by people to push the market higher. But at what expense? The huge influx of money into the US economy caused the value of our currency to plummet. Now, prices are rising as dollars become worth less and less. This is what we call inflation, and it has often been the precursor to economic collapse. For many analysts, a market crash seems incredibly likely. The standard Federal Reserve response to inflation would be to raise interest rates. Unfortunately, neither businesses nor the average citizen could afford high enough interest rates to contain this new inflation. This leaves the government between a rock and a hard place. Either way, fixing the economy won't be pretty. Jeremy Grantham spoke of super bubbles in the clip we just rolled. So what role do these play in the stock market collapse? Super bubbles are distinguishable by two characteristics. One is naive optimism in the market pushing assets or securities to higher than ever before. Let's use a classic example for this one. The tulip bulb mania of Holland in 1634 is the first recorded financial bubble that we know of. For some context, tulips had been recently introduced and widely popularized in Holland. They became incredibly sought after, and people soon began buying and selling them purely because of their value. Naturally, this caused prices to soar to never before seen levels. Eventually, the prices reached a fever pitch, and people began to stop demanding tulips. The bubble burst, and the insane valuation of these flowers looked like a foolish mistake for investors. The other super bubble characteristic is speculative stocks falling as blue chips rise. This has only happened in 1929, 1972, 2000, and last year. This was one of the major indicators of the dot-com crash in the year 2000. New internet companies were being invested into heavily by everyone, spurred by the promise of never-before-seen services. Of course, while this was true, the optimism pushed investors a little further than they should have dared to go. At one point, the combined worth of NASDAQ internet companies was heavily outpacing the GDP of nations around the world. Then, things began to change. Slowly at first, and then rapidly. The speculative internet stocks began to slide, and the tried and true blue chip stocks, like General Motors, were being bumped up. This was the beginning of the bubble's pop, as professional investors and advisors recognized that the value of these speculative stocks was nearing unmanageable levels. When they began to get out, everyone noticed. As quickly as it inflated, the balloon collapsed. Bubbles and super bubbles can appear in anything from stocks to assets like real estate and even commodities like gold and silver. Some people say that the growing interest in cryptocurrency could risk creating a bubble itself. If you want to learn more about how crypto is actually putting people ahead of these tough economic times, check out our video on Raoul Pal about how crypto will level the playing field for younger generations. All this talk about financial collapse and super bubbles can make for an anxiety-inducing YouTube session. So let's fight this doomsday conversation with some talk about what you can do to prepare. When you have a plan in place to protect your wealth, you'll sleep much better at night. When you are handling your investments, it's important to remember that your mentality affects your success. You've likely heard the saying before. It's Warren Buffett's most famous line. We must be fearful when others are greedy and greedy when others are fearful. But how do we apply this to our investment goals? At its most basic, this is about self-control and emotional regulation. If you are holding stock and it begins to drop rapidly, your first instinct would be to sell out and cut your losses. There are two reasons a stock may be failing, and this is the correct reaction to only one. Let's take, for example, a failing industry. Maybe you're invested in DVD and video rental companies. Others are likely fearful that this particular market is on its way out, so they sell. As the stock loses momentum, you can see that the industry as a whole is coming to a close. Stocks in these positions do not rise again, and cutting your losses is smart. On the other hand, let's look at the current losses that we see in the S&P 500 and other stock market indices. This is not happening because all of these companies are failing. Other forces are moving the market, such as inflation fears and the threat of war. It is generally outside influences like this that causes fluctuations in price. If this is the case, then the market can be expected to rise once again to higher levels as it always has. Yes, even in the case of a market crash. History may not repeat itself, but it certainly rhymes. Here we see why being fearful when others are greedy can lead you to losing wealth prematurely. The right course of action would be to not sell at a loss, despite everyone jumping ship. Your stock will almost certainly rise again unless the company goes under. Furthermore, if you have extra money, it will be time to get greedy and buy up cheap stocks. This is one major key to the millions that major investors make, especially during a market crash. Jeremy Grantham is doing his duty by warning the world of an incoming crash made by our super bubble. Whether you believe him or not, the market signs are worth paying attention to. By staying in tune with the market, you can make the correct moves and protect your wealth. Thanks for tuning in again to Profit Protection. If you enjoyed this video, leave us a like and subscribe to the channel so that we can continue producing high quality content for you.